for gold and silver. That's substantially higher than where it is today. And the more of this stuff that they do, the higher that number goes. I just did the calculation yesterday, and I think it was like somewhere north of $38,000, almost $40,000 on gold, and about $2,000, $1,900 on silver. So at these current price levels, or even $10,000 on gold and $1,000 on silver, still undervalued.
Yeah. All my money in silver or gold now, and then the price starts to drop, and you've got to wait a month or 2 months or 3 months or 6 months for it to get back to where you paid. And that, that can be really, really distressing and cause people to panic and say, I made the wrong decision, get out. But going in gradually, well, then you won't pay the highest price, whatever happens.
Gold and silver are still being discussed as if they were expensive, even though the data suggests the opposite. Even at today's elevated levels, both metals remain deeply undervalued relative to currency debasement and long-term monetary expansion. Lynette Zang, a longtime monetary historian, and Clive Thompson, known for his macro and metals analysis, framed the argument in terms of math rather than emotion. Based on current debt levels and money supply growth, their calculations point toward gold needing to trade near the $38,000 to $40,000 range and silver closer to $1,900 to $2,000 to rebalance the system. Even scenarios often called extreme, such as $10,000 gold or $1,000 silver, would still represent undervaluation in real terms. They also stress discipline. Deploying capital gradually helps avoid emotional mistakes during inevitable pullbacks and volatility. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I mean, these two assets, silver and gold, are used in every single sector of the global economy. They have the broadest base of demand as well as the broadest base of function of any asset. But resources, I think, are going to, that's what's key right now. And that's what we're working on controlling. And the more of those that we control, and we need those rare earth, and we need the silver and the gold to build out all those power plants for all of these digital assets that are they are being shoved down our throat. Yeah. I mean, I think it's really interesting when you look at the markets and what's been happening in the cryptocurrency markets like Bitcoin, et cetera. And then you look at, and it's been in a winter, right? They've been in a bear market. But on the other side of that, you see all the banks and the governments and the major corporations full throttle into adoption, right? Mm-hmm. Are they hiding something, or do they want us to think something else over here? Or, why? Did they get that far ahead of themselves? And by the way, I can determine, it might take me a minute to figure it out, but I can actually calculate the fundamental value. That's the true value of any asset or any instrument. But, and I am doing a piece on that, so I'm going to have to look at the cryptocurrencies, but I have no idea how to do that on the cryptocurrencies yet. And I haven't jumped into it. So you'll have me back afterwards and we can talk about it.
We will.
But I go back to, well, how many times can you be lied to when you do not know the truth? If you do, I can't give you a lot of guarantees, but this one I can 100% give you. At some point, all assets, all instruments go to their true fundamental value, period. For gold and silver, that's substantially higher than where it is today. And the more of this stuff that they do, the higher that number goes. I just did the calculation yesterday, and I think it was like somewhere north of $38,000, almost $40,000 on gold, and about $2,000, $1,900 on silver. So at these current price levels, or even $10,000 on gold and $1,000 on silver, still undervalued. Yeah. But how do you determine that with stocks? Well, you look at the real trend, and that's the purchasing power value. Yeah. And that's probably what we'd have to look at with cryptos, but I am not prepared to say that yet because I haven't really sat down and wrapped my brain around it. but I will. I don't think that there's any reason. I see no reason why we can't commingle the old, the stability and the foundation of redeemable gold in the monetary system again, along with the digital component. It's not like I think that stuff is going away. It's not. But if we don't do that, then what are you in? You're in a full surveillance currency.
Yeah.
And like we saw in Canada before we even got there, they didn't like what you were doing. Boom. They cut you out of the system. And they cut out anybody that was trying to help them. And we see the social scoring in China and we better take heed so that we can see what's coming and we can demand it just by enough people buying gold. That's all. It's simple. Just by enough people buying gold.
When you're wanting to buy gold or silver, I don't think it makes any sense to go all in at once. Otherwise, you might find that the day after you bought it, there's a big dip. So the way to play the game is ease in gently, buy a little bit now, sit on it, see how you feel, buy a little bit more. Maybe you'll get it cheaper. Maybe you'll pay it more expensive. But it doesn't matter whether you pay little, either more or less. What you're doing is ensuring you will not be the person who paid the highest price ever, because you'll have paid an average of the prices over a period of time. What would hurt really if you go in and say, I'm putting all my money in silver or gold now, and then the price starts to drop and you've got to wait a month or 2 months or 3 months or 6 months for it to get back to where you paid. And that can be really, really distressing and cause people to panic and say, I made the wrong decision, get out. But going in gradually, well, then you won't pay the highest price, whatever happens. If you're planning to trade in and out, we're obviously not talking here about long-term holdings. You probably shouldn't be holding the physical for trading. You should be buying paper gold or paper silver, because that has a lot less frictional cost when you go in and out, and it's much easier to trade. You can just pick up the phone or go online and trade it. So I think everybody, if they have an idea that they're going to sell at some price, they should have some of their gold or silver in a paper form. Now, I know most stackers and traditionals hate that, but if all you're trying to do is get in and get out, paper is the way to go. But on the other hand, everybody, absolutely everybody, should have some physical as the plan B. It's not anybody's liability. It's out of the financial system. And I think in the world we're in, you need to have some assets, that will include your house, of course, but other assets which aren't part of the financial system, which are genuinely yours, which you can touch and nobody can take them away from you. And gold and silver are a way to do that. And that's not the sort of thing you should be selling. So, but if you're minded to sell, you've got paper silver. One of the rules I have for everything, and that includes equities or whatever you like, but it applies to just as much to paper and silver ETFs and so forth, is when you feel the urge to sell, take a little bit of the profit off the table. And I personally tend to leave the original holding and some rolling. And I know too many people who see a surge in the price of something and say, well, I've got to grab this price because today's price is an accident and last week's price must have been the right one. The fact it's just gone up means everybody's making a mistake because it's going to go back to last week's price. So they immediately rush to sell to grab that new price. And a week later, they're regretting it like anything because, as we saw, silver, a lot of people thought, okay, 66 silver about. And now where are we? We're eyeing 90. It's 81 or something like that now. So if those people who did rush to get out last week, and there were plenty of them, because a lot of people write to me about this, if they would have just sold some of their silver, they'd still be in the game. They could feel disappointed they'd sold a bit, but at least they'd still be in the game. And if it went down, they'd be happy they sold a bit.
Gold and silver sit at the center of the global economy, touching nearly every sector through energy, infrastructure, technology, and industrial production. That reality is becoming more visible as governments and corporations race to control critical resources needed for power grids, digital systems, and rare earth supply chains. While speculative assets cycle through booms and busts, the underlying materials that enable modern systems to function remain essential and scarce. All assets eventually gravitate toward their actual fundamental value, and for monetary metals, that value rises as currency purchasing power erodes. At today's levels, gold and silver remain historically undervalued, even after strong rallies. The practical approach in this environment is gradual positioning rather than emotional all-in decisions, separating long-term physical holdings from shorter-term trading exposure. This preserves participation while reducing regret during volatility. Let's get back to the interview.
What happens when the demand exceeds the supply is the price has to rise, so recycled silver comes out of the woodwork. And of course, there's plenty of silver above. Well, I say there's plenty. There's less silver than there used to be above ground, but there's silver above ground, and every kilo of silver has its price. So as the price goes higher, there will be sellers, and that is what goes to meet the demand. But we've got another side of the equation. We've seen in recent weeks, and it's anecdotal evidence, that there's been a shortage of physical silver for delivery, for immediate delivery. And the reason we've come to that conclusion is the gap which has opened up between the price of silver in Shanghai and the price of silver on COMEX. Now, the two have traditionally traded within 50 cents or a dollar of each other, and that premium has gone to, at times, $7, $8, $9. It was, I haven't got it. I think today I saw it was down at $5, but it's still 5 times the normal level. So that what that means is the silver isn't there for people to arbitrage it away. Otherwise, they'd be moving silver on a plane to Shanghai, they'd be selling it immediately and delivering what they've just sold the next day. So it's not happening, and that's probably because there isn't the silver to be had. People can't lay their hands on silver easily. The other slightly less provable evidence is we're hearing that the lease rates on silver are very high. I've been trying to get my hands on the current lease rates, and everywhere you ask, some people say it's 30%, some people say it's 8%. But anything over 1/4% is another problem. It basically means that the manufacturers, not the manufacturers, the consumers of silver, the big auto companies, the solar panel companies, they need to get their hands on silver now. They've been working on what's called just-in-time supply chains, and suddenly they've realized that's a bit too risky. We better have a month's supply or 2 months supply, and now they're all rushing at the same time to say, we want to be first, make sure we don't have to shut down our production line. We can't, it doesn't, if you've got an ounce of silver in a car, and it's something like this, between 0.6 and 1.8 ounces of silver per car, we're talking about the difference in the car price of going from $50 for an ounce of silver to $100. We're talking about an extra $50 on the price of a car. They're not going to shut down the production line because it costs them more for the silver. So there's this rush going on by manufacturers to say, we're not sure if this silver shortage is there, but we've got to get it, and that's pushing up the short-term price.
Take a look at what's happening in the Shanghai exchange, where there are pretty lofty premiums for delivery, and even the backwardation that we had for a minute there in both the gold and the silver markets, meaning that the price that you were paying for immediate delivery was higher than the price that you were paying in the futures markets. All of these are technical indicators of that shift unfolding. I also think that in the metals market, we are going to see, first of all, both gold and silver are technically overbought, not overvalued, just overbought. So I think that we could see, if there's not a lot of geopolitical shock that the markets don't like, then I think we could see spot gold and silver stay within a range, giving the technicals a chance to catch up before it goes on to its next leg. If, however, we do see that might tested, then I think we could easily see silver, maybe $150 or even $200 on spot market. And I think we could easily see gold maybe 6,000 on the spot market. Even those numbers are still far below their true fundamental values. I think silver is safe. I mean, I've had a lot of people ask about a silver confiscation, but keeping in mind that silver gets used up in industry, it would be really harder to track how much of that they've actually gotten because they can't tell. It just has been used up. But you've got to hold it. I mean, it's, you do what I do. If it's in the paper markets, then it doesn't really mean anything because you don't actually own anything. All you're trying to do is be a trader and get some gains.
Yeah.
So you've got to hold this physical, and then the gyrations in the markets don't matter, but you do need to be really clear on what its true value is. Because if you're not, and it's the same thing with stocks or dollars or bonds or anything, if you don't really know what their true value is, then how do you know if something's undervalued and you want to buy it or overvalued and you want to liquidate it? You can't trust Wall Street. They don't give you good price discovery. They give you current trading price discovery. We've got to get redeemable gold, sound money back in the monetary system again so that the public can take back their power. We gave it away. It's time and the opportunity to take it back. Because if we don't, then you're going to lose all your freedom. And that, look, I'm old. I have plenty. I'm not worried about me. I'm not even really worried about my family, to be honest with you, because I know what I've done. But I am worried about everybody else's family and everybody else's children. I really want a level playing field for the world. And as long as you have 1% lording over the 99%, you are not going to get a level playing field. And even going into a brand new system where then everything will be at the highest level of purchasing power and the highest level of opportunity, if you don't have something to work with going into that, you don't have that opportunity. But redeemable gold in the system would level that playing field. The public would take their power back, and we would have more freedom and more control.
When demand begins to overwhelm supply, price becomes the only balancing mechanism, and that process is now visible across the physical silver market. Tight availability for immediate delivery, widening price gaps between global exchanges, elevated lease rates, and brief episodes of backwardation all point to growing stress beneath the surface. Manufacturers are no longer optimizing for price, but for certainty of supply, choosing inventory security over just-in-time efficiency. That shift alone changes the market structure. Even with short-term overbought conditions, these dynamics suggest consolidation would be constructive rather than bearish, setting the stage for another powerful advance. Physical ownership matters in this environment because paper pricing reflects trades rather than accurate availability. As monetary confidence erodes, the distinction between price and value becomes critical. Understanding that difference is what allows capital to move calmly through volatility rather than react emotionally. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.